Welcome back. You're watching Your World at 10 now. A few days ago, the government changed the FDI pricing guidelines for unlisted companies. Earlier, foreign investments in unlisted companies were to be made at a floor price, minimum floor price, at a valuation determined by the CCI guidelines. Now, effective late last month, the valuation will have to be done in a discounted cash flow method. Will this change end up raising the minimum floor price or the entire valuation to a prohibitive level? Well, joining us to discuss that, Luis Miranda, President and CEO of IDFC Private Equity and the interim head of the India Private Equity and Venture Capital Association, and Abizar Divanji, Executive Director at KPMG. Luis, Abizar, thank you very much for joining us. Luis, I hear that the private equity and venture capital industry is very agitated with this change in the pricing guideline. Really, is this going to make investments a lot more difficult?
Well, Menka, this clearly was something which was surprising. It's not something that we expected. So we've started a discussion with the RBI to understand why this happened and what can be done about this. Mm-hmm. The RBI feels that the old guidelines were dated and therefore needed to bring in something which was more contemporary based on how investors look at it. But the moot point is whether this will actually impact deal flow. And remember, any deal done between for an investment is between two consenting adults. And therefore, there is a price at which the seller is comfortable selling at, and there's a price in which the buyers are comfortable buying at. What happened so far is that under the current guidelines, deals happened because the seller was comfortable selling at that price. So if sellers were not comfortable or wanted a change in this, I fail to see what the problem was, because they were willing to do deals at the earlier level anyway. And if they feel that the price is going to go higher than what they got earlier, then the buyers will not be buying. So it's going to come to somewhere which is workable. But also bear in mind that we haven't specified, that the regulations don't specify, and I'm just going to read back what it says, is that it will be on a fair valuation basis done by a registered Category 1 merchant banker or a chartered accountant as per the discounted free cash flow method. There are no definitions as to what discount rate to use, what WACC, what growth rates, number of years of cash flow, etc. So it's very possible that this is not going to necessarily drive the pricing of deals. It's going to be determined based on a negotiation that a buyer is willing to buy at. And if frankly people are not comfortable of the discount, if the valuation basis comes out to be too high, no deals will happen anyway. So I think there is some element of flexibility in this whole thing because of the fact that the valuation parameters haven't been defined. Mm-hmm. It does obviously, whenever there's any change, cause uncertainty, and it's something which we have taken with the central bank, and we'll hope to get some conclusion soon.
All right, Luis, most of the private equity players that I was talking to, or have been in the course of the last 10 days, ever since this change in FEMA regulations came about, many of them said that, hey, listen, we're already entering India and Indian companies at premium valuations because promoters are not willing to sell at anything less than a premium. So actually, even if the minimum floor price does move up, it's not going to dramatically impact us. But the sense that I got was that it's more likely to hurt the venture capital industry because that's where you're putting in money at a very early stage. And it's very unlikely that venture capital investors will want to bring in money at a premium at that early stage of an enterprise in that sense. So is that something you'd agree, that this will probably be more prohibitive for venture capital than private equity, notwithstanding all the points that you make that these are deals between two consenting adults? Why do we need RBI to dictate transaction prices? And yet DCF gives you some discretion or flexibility, and so it may not really mean the end of the world for you.
I think it's a question of us sort of figuring out, will this really have an impact? Clearly, I mean, it is a change from what we're accustomed to, and it's useful if therefore there is dialogue before such a change happens. And you're right. I mean, today the valuations which promoters want are high, so it's anyway difficult to close deals. This is not going to have an impact. But will it impact venture capital deals more? Not necessarily.
Okay.
And it all depends on, as I said, how the DCF valuation is done and how it's certified. So we are in talks with the RBI. We will be sending them a note on this from IVCA. And what's more important is that the central bank is willing to have a discussion on this.
In which case, Lewis, ideally the dialogue should have taken place earlier and not after the notification. So, but I get the very correct points that you're making, that all of this can be resolved through conversation. I understand that, you clearly don't want to rile the regulatory bodies in any fashion. Abizar, depending on which private equity player you talk to, some of them build out a doomsday scenario, and others, like Lewis, play this down a little more, saying, yes, it's new, but we can maybe manage or live with it. What do you think the operational impact is going to be on both venture capital and private equity deals?
See, thanks, Megha. I actually do believe that a couple of points are right to say that deals today are happening at market rates anyway, so how does it matter?
Right.
But don't forget, what we're really talking about are deals which happen for pure equity players, as in people who just invest in equities. Take the whole issue of convertibles. And that's what most private equities are doing today, either on the venture side or otherwise. Where there are valuation differences, I think a convertible is a very good way to actually make these meet. Because really what happens is, a promoter believes in an optimistic situation, a private equity guy believes in a realistic or a pessimistic position, and really the one way to get it together was a convertible method. Because what you do really is, you put in the money, you ask the promoter to put where the money, where his mouth is, and then actually do the conversion at a later date when the cash flows become more certain.
Right.
Now, if in that kind of situation, if you look at it, if valuations have to be decided up front, it will be very difficult to actually do it, because the real bet is on whether the growths will be met or no. When the growths get met, the valuations are anyway higher. So what really happens is a conversion formula is agreed.
Right.
And that conversion formula gives a particular discount to an investor who has actually put in money up front to achieve those targets anyway. So ideally to say that on conversion one should only do it at a fair value is a little bit unfair to deals like this. So really the area that will be most impacted is the convertibles part. And here obviously there is an ongoing argument with the RBI, where the RBI believes that the press notes that came out actually spoke about ascertaining valuations upfront.
Right.
And while the industry and everybody else has represented that, the valuations do not get set upfront. So in a situation where valuations do not get set upfront, this circular, which basically talks about a free cash flow valuation, is not going to really meet the end purpose.
Lewis, you want to react to that
here's
quickly?
The answer is
maybe vanilla equity deals will not get impacted, but like Abizar said, what happens to convertibles?
No, I agree with you. It does impact convertibles. There is a lot of uncertainty on the convertibles, which is what is being discussed.
Has RBI promised you any kind of change, or have they said they will look into it?
I think that the message from the RBI is that they want to have dialogue.
Okay.
And so that's really it.
All right. So, what I understand, the effort behind this move, of course, is to avoid or to, sort of deter underpricing of deals. And you know what I mean when I say underpricing? Often the foreign route is used sometimes by promoters in India to be able to come in and buy equity cheap. So if that is the goal, and that's the reason why RBI is interfering with two consenting adults and putting in minimum floor prices or artificial price barriers for transactions, is there a better way that the RBI can mandate? Like maybe, would it be better if they gave you a couple of options for, between DCF or other valuation methods to be able to determine fair value and then therefore come in at that price? Or what is the alternative that you're presenting to the RBI, Lewis?
We're looking at various alternatives, and Menika, since you sort of have already are throwing up options for us, that's very useful. And would love to get some more options from you already on this. Thank you.
Of course, I'm the wrong person. Abizar, what do you think the solution to this is, really, honestly? Because I don't think the RBI is going to do away with mandating a floor price.
I think you need to jumble up all the regulations. If you look at the FDI guidelines that came out, the press notes,
right,
it basically says that every agreement effectively needs to be filed with the RBI. So once you file those agreements, then the RBI or the DIP, etc., need to consider valuations in the light of those agreements, assuming that those agreements are acceptable. And because these agreements have been entered into by two mature individuals, the valuation should just be made sure that they are in line with those agreements, in a way. Because really what happens is, that it is an agreement between a willing buyer and a willing seller, and if looked at holistically, you will find that this transaction would be fairly valued, because otherwise the buyer or the seller will not agree.
Right.
So I think if the DIP, which actually gets these shareholder agreements with them, makes sure that the ultimate valuations are in line with those agreements, I think it will prove a great point. Secondly, I think we are in this fair value fixation as far as the government is concerned, because we have the income tax section 52, which also talks about fair valuing of domestic transactions.
Right.
And now we have fair valuation on the foreign transactions. So at the end, I think fair value is like beauty, it's in the eye of the beholder. And frankly, the level of maturity needs to be developed with the regulator, which will, I think, come if they start with actually making sure that the spirit of the agreements entered into are met with while doing the valuation and the conversions.
Okay, all very valid points. Last word to you, Louis, though this does put the discretion of determining whether the valuation is an acceptable one or not in the hands of the Reserve Bank of India. So like you pointed out, there is no mandated discounting rate, etc. in this notification of any form. You could do an honest to goodness, DCF valuation and yet have RBI pick holes in it. So that's the double jeopardy in this.
True, and as I said, it's early days, it's just come out. I don't think anyone sort of yet filed something over there with the central bank, so we don't know how they will react to it. So I think it's a bit premature to get all excited, but the fact is, yes, it has come as a surprise. We are going to write to them through IVCA, and it's something which I think the main point is we don't want to have uncertainty. If we're clear that this is what the process will be, this is how it will be done. If there is a valuation which is submitted and it's signed off by a merchant banker or a chartered accountant, will that be taken and therefore no other questions asked? And then that's fine. But if it's going to be a situation where then that's going to be analyzed and reanalyzed, then it's going to be a problem, because it will hold up transactions.
Right.
And that creates uncertainty.
All right, this is just
so it's
one
to do with the process also, which is important.
I get that. This is just one of the many issues I know that the IVCA hopes to represent to the regulators. Gentlemen, we're out of time tonight, but I hope to come back to both of you to be able to discuss the many other issues, regulatory that is, that are plaguing the venture capital and private equity industry. Louis, Abizar, thank you very much for joining us tonight. And Louis, all the best with your representations to the Reserve Bank of India. We'll invite you back a month from now to see if you had made any sort of headway with the central bank. Thank you very much for joining us tonight. And that wraps up this edition of Your World at 10. Thank you.